Heineken is buying the beer unit of FEMSA, Mexico's biggest brewer. The Dutch company is spending $7.7 billion to expand in Latin America, where Mexico is the fourth most profitable beer market. We partner now with the FT to bring you Lex on Bloomberg. You got a sneak peek at the Financial Times' flagship column a day early. Joining us now from London is Neil Buckley. Neil, always glad to speak with you. So everyone has seen SAB Miller as sort of a front runner for this deal. So how much of a surprise is it that it's Heineken who wins?
It is quite a big surprise. There's been a lot of interest in this deal because good emerging market beer companies don't come up very often, and emerging markets is really where all the growth is in beer. A lot of the companies are family-owned or state-owned, so this is quite a prize asset that came up. SAB Miller had been seen as the front runner all along. Its shares had been going up in expectation that it would secure this, but SAB Miller pulled out at the last minute. It's being said they were not prepared to match Heineken's offer, and Heineken has stolen it the last minute, if you like, and so we have a bit of a surprise this morning.
So why does Heineken need this deal so much? I mean, why is it so important to the company to get it?
Well, it's seen as being very important for Heineken because of all the big European brewers. Heineken has the least exposure to the fast-growing emerging markets that I was talking about. If it hadn't done this deal, then it would have been left much more reliant than some of its competitors on slower-growing mature markets. What this deal does is it is going to increase its top-line growth significantly because it's buying into faster growing markets. It's also going to give it a very strong position in three of the biggest beer markets in the world in profits terms. That's Mexico and Brazil, as well as the US, where FEMSA has a strong import presence. And there's going to be opportunities, for example, to sell Heineken through FEMSA's distribution network in Mexico. The potential for Heineken to gain a very big share in the Mexican market, and to put some of FEMSA's brands through the Heineken network in places like the UK and Europe. That's brands like Dos Equis and Tecate, where there's big potential. So I think this all round is a very positive deal for Heineken.
So will Heineken shareholders welcome the news, do you think?
They already are welcoming the news. The Heineken shares are up quite sharply this morning. I think shareholders are pleased that Heineken is doing this deal, that it hasn't been beaten on it, but they're also going to be relieved for two reasons. The first one is that Heineken has not ended up in a bidding war with SAB Miller and ended up overpaying, which was one fear. They're paying about 11 times, if you include debt, about 11 times earnings before interest, tax, depreciation and amortization for this deal, which is pretty much in line with other big beer industry deals. Okay. The other concern had been that Heineken would issue a lot of new shares. They're not doing that. They're keeping the existing structure pretty unchanged.
Neil,
that's positive.
We thank you as always. Neil Buckley joining us there from the FT in London.